Good morning. Mark Ostwald from ADM Investor Services International with a few thoughts on where we are with central bank rate expectations and what we should be considering in that context. Obviously, last week we had the big shock from Mr. Trump in which he threatened to try and solve the immigration row with Mexico via use of trade tariffs. We have that deadline coming up this weekend and we'll see what happens. In the meantime, financial markets have basically moved to discount the first rate cut by the Fed, as one can see on the table, by July, and a further 3 rate cuts as we go on, which is understandable in the context that the signals that we're getting on global trade tensions would seem to be very, very negative for the global economic outlook. And with the Bundesbank revising down its economic forecast for Germany this morning very drastically for 2019 to just 0.6 from 1.6 previously, the signals, again, not particularly good. Nevertheless, one always has to consider things in the context of how much distress is there in financial markets. And I think this is really where the important thing is, because if we are going to have 3 rate cuts from the Federal Reserve and 4 by the middle of next year, then there really needs to be some quite concrete signs that there is some distress in the system. So if we have a look at the next chart, which is the 2 10-year spread, I know a lot of people are looking at other spreads which are inverted on the US curve, but this one to me is always the most important. We've actually steepened it up very modestly, but we're still in the broad range that we've been for the past 6 months. So there's no real sign of distress there. If we move on to the next chart, we've got the VIX volatility chart. This, if anything, is the biggest sign normally that we get of distress in the financial system. As we can see, back in December, after the Fed had hiked rates for the last time, as it appears in this cycle, we had an enormous spike up to 35%. We've had a marginal spike, but we remain comfortably below 20 and very much towards the low end of the range that has prevailed. So there's no distress there. And indeed, it seems, if we judge by the rally that we've seen in equities this week, that there are plenty of people who are more than willing to buy the dip here, or indeed in credit spreads, which also have widened marginally, but only largely because we've seen that fall in US Treasury yields rather than a rise in actual credit yields. So moving on to my next chart, this is the US dollar index, and this is perhaps interesting from the aspect of what we're discounting in terms of Fed rate cuts, because if we were really thinking that the spreads between US interest rates, official rates, and those in the G7 and indeed the emerging markets were going to narrow as substantially as is implied by what the market's discounting for the Fed, then we should start to see the dollar come under some pressure. Eminently, there are questions about other countries, particularly the euro area. We're not looking at a great situation, so it wouldn't necessarily be a charge into that. But one would expect people to be looking at the forward-looking spreads and thinking that there are opportunities both in emerging markets and perhaps in other countries where yields are slightly higher or not that much different from the US. That is clearly not the case. In terms of the inflation outlook, I think the one thing that we actually need to keep a very close eye on, and the inflation outlook will certainly be a key thing for the outlook, will be a key thing in terms of the outlook for rates, is oil prices. And my last chart is just an interesting one in terms of the fact that much as we've seen a big fall in oil prices, somewhat of a recovery late in the week, we are actually a situation where major oil supply disruptions have not been this large since the Iraq-Kuwait war. And therefore, we should be thinking that as much as we're worried about global oil demand, there is quite a lot of supply disruption about, and that should support prices in the longer run, particularly if we go into a deficit in the second half of the year.